The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. Wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Brought to you by Zecco. Zecco is quite possibly the best value in online investing, offering a fully featured stock and options trading experience, spectacular customer service, and tons of free tools at pricing that is 30 to 50% less than the big guys. Keep in mind, options involve risk and are not suitable for all investors. Please read characteristics and risks of standardized options. For more information, including special offers, options education, and disclosures, visit Zecco.com/bootcamp. Now, let's start getting you into peak options trading shape. Here are your Options Bootcamp trainers, Mark Longo and Dan Passarelli.
All right, and welcome back to Options Bootcamp, the show where we break down raw options recruits and rebuild them into seasoned options veterans. My name is Mark Longo from the OptionsInsider.com, as well as the Options Insider Radio Network, and I am joined here on the old parade grounds by my fellow drill instructor, good old Dan Passarelli. He is the major domo over there at Market Taker Mentoring. He's the man who runs the show. Dan, welcome back to the program, sir.
Oh, I'm always glad to be back, and I think domo is a compliment. I was going to say, what'd you call me? But
it was either that or viceroy. I haven't decided what your title was this week. I know you change the business card over there on a regular basis.
Yes.
Perhaps Archduke? Is that work for you?
Yeah, I think this week Archduke would be fine.
Okay, the Archduke over at Market Taker Mentoring. And Dan, we have a great topic in store for our listeners today. We're going to dive into the world of spreads. But before we do that, we have to dive into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, prepare to learn. Yes, sir.
All right, and welcome to the basic training segment. This is where Dan and I give you those basic skills that you'll need to become successful options traders. And today, Dan, we've configured the old obstacle course for spreads. It looks like a pretty good one today, if I have to say so myself. I think the mud pit is especially muddy this week. What do you say?
Yeah, I'm looking forward to it. This is going to be a good one.
Now, we've been waiting for this moment on the show for quite a while because spreads really are the defining characteristic of options. You know, anyone can come in and buy or sell an individual option or even an individual stock or some of these other product categories. But spreads are where options really start to come into their own versus other financial instruments. They allow you to construct positions and mitigate your risk and do a lot of other very interesting things that you simply couldn't do with another financial instrument. It's the reason why I got into options back in the day when I was still in college and taking a course on derivatives, and I learned that I could construct other synthetic underlyings by using option spreads to do that. That just struck me as a very interesting type of thing and something that I wanted to learn more about and a product that I wanted to learn more about. It seemed to me that anyone could go out there and buy or sell stocks, but the ability to really execute complex option spreads in an intelligent and risk mitigating manner really seemed to be an interesting and compelling challenge. And lo and behold, all these years later, it has led me to the training ground here with you, Dan. So why don't you give our listeners that's my kind of intro to spreads, where I kind of got lured to the dark side of spreads. Why don't you give our listeners your quick intro to the world of spreads?
Yeah, well, I guess I never really thought about it, but I guess it just kind of came through the trial by fire nature where I learned options. I started out as a clerk down on the Board of Trade floor and got hooked up working for a market maker. And, he'd hand me some card with 2 different trades on there. And he said, and I look at, oh, you got these 2 trades. No, that's not 2 trades, it's a spread. What are you talking about? It's a straddle. Don't you know anything? Whack you in the head and, okay, geez. Okay, this is a straddle. And then, I found that there's all these different trades, all these different spreads, and, trying to kind of get a handle on them. It was kind of fun. It was kind of a fun learning experience, just sort of memorizing all these different trades and stuff like that. But they didn't really mean anything to me until I really started scratching under the surface. All these spreads don't just exist to have cool names and to, have something for traders to yell at their clerks about screwing up. They are, just like you said, a really fantastic tool to be able to control your risk and to be able to trade just a cross section of a particular opportunity. You buy a stock, okay, sure, you do that because you're bullish. But here, you can put so more into the trade. I'm bullish between this point and this point only. And that's the only risk that I want to take is that. And of course, you can trade the option-centric risks like time and volatility and interest rates and dividends and such with spreads as well. And they're really, really super powerful tools.
Yes, and of course, listeners should realize that you and I came up in a much harsher environment from an educational perspective than I think a lot of our listeners are used to. I mean, we joke about being options drill instructors here, but in reality, yes, we're much less harsh than than the way you and I certainly learned, where it was far less forgiving for an error. Usually, it meant your job was gone. But so that's a nice trial by fire type of environment to learn spreads. Another way to do it is in a more leisurely environment, like on this program today. So spreads, let's get into that then. What are we talking about? We throw this term around, spreads. An option spread is a very simple thing. It's basically you're buying one contract and you're selling another contract against it. That's usually when you're buying the spread. It could be vice versa. You could be selling a contract and buying another against it if you are selling the spread. But essentially, those are the 2 flavors of spreads. I'd imagine most people coming to this program learning about spreads for the first time will start off buying spreads. So that's where we'll focus most of our efforts today. Now, why would you do this? Why would you trade a spread versus trading an option outright?
Well, the answer to that question is deeply rooted in why I guess they're called spreads to begin with, because you spread off risk. Okay. Why would you buy a call? Well, you'd buy a call because you think the underlying stock's going higher. Okay. And arguably, buying a call can be much better, much less risk, much more leverage than going out there and buying stock. But you can do even better. You can spread off some of the risk of buying a call when instead you buy a call spread. The risks that you have when you buy a call is, well, I guess really threefold. There's 3 main risks. One is you could be wrong and the stock could go lower. Every penny you put into that call, you stand to lose. You can lose 100%. Another risk is the risk of time decay. Whenever I hold a long option, as each day passes, I lose a little bit each day. And then the third risk is, volatility. As volatility changes, you can profit or lose on your call independent of direction and time. So you've got these 3 things you need to worry about. And lo and behold, losing 100% is a pretty significant risk. Even though it's a limited risk, it's significant. So what you can do instead, you can buy that call and at the same time sell a higher strike call to create a spread. So therefore, because you're buying one option and selling another, you pay much less. So even though you can still lose 100%, it's 100% of a whole lot less capital that you have at risk.
Yeah, and that's definitely the primary motivating factor for a lot of people who come to spreads for the first time is they do exactly what you just described, Dan. They start looking at some at the money or around the money options, and they say, wow, these are kind of expensive, and I could lose all of this if my trade goes against me. And then they start looking at spreads, and they say, wait a minute, I could add this other component to my trade, make it a spread, and dramatically reduce my initial outlay for that trade, and therefore dramatically reduce their overall risk of that trade to me. So that's where a lot of people come into spreads for the first time and start realizing the value of it instantly, is that it limits their outlay. So that allows them to trade more, to have a more effective risk profile, and do a lot of other things that are very interesting from an options perspective. So maybe let's dive into it from that perspective then. I'd imagine most of our listeners coming to this are going to start off with your typical long call spread. And that's what you just described as well, Dan, where you buy one strike on an option, let's say good old XYZ. So you buy an XYZ, one strike of an option, then you sell the option several strikes or more higher than that. And it's important from that long perspective to remember you're selling the strike above it because you want the underlying to be able to appreciate, and you want to capture that. That's the whole reason you're buying that spread to begin with. So if you sold the strike below it, you would essentially be selling that spread, and you'd be cutting off a lot of your all of your upside. So that's a discussion for another day, the selling of spreads. But yeah, people definitely want to think of those as what they're also. These spreads are also known as verticals, and you can imagine why. If you look at the strike chain of an option, you can see one strike and then you're selling another strike above it, so you're trading essentially vertically, and so that's where those spreads get that name of verticals. So let's walk through an example there of the typical long call vertical on our good old friend, yet again, XYZ. We should start tracking our P&Ls on this show here in XYZ, Dan. It might be a fun scenario for our listeners to see. So here we are, XYZ, once again trading at 100. It's pinned at 100 all the time, Dan. I don't know. Maybe we should be selling premium at XYZ because that doesn't seem to go anywhere.
Yeah, exactly. The 95, 100, yep, 105
all day long. So XYZ stock is trading for 100, and you're looking at it and you're thinking about buying a call in XYZ. So let's say that XYZ 100 strike call is trading for $3. And you look at that and you say, well, that's a little expensive. I could buy that and spend $3 for one lot, or $300 for that one lot. Remember, there's a multiplier. But if you start looking at some of the other strikes and you see that the 105 call, the next strike up, is trading for $1. And now you start to remember what you learned listening to this program about spreads, and you realize that if you buy the 100 call for $3 and you sell that 105 call for $1, you've now just reduced your overall outlay to $2. And so there you go. You see initially the immediate benefit of doing spreads is that it has reduced your overall outlay for that trade by 30%. So that is an immediate gratification bonus, which is nice because not all too often some of these strategies don't exactly provide immediate gratification for the user. That is an immediate benefit of doing spreads. And let's look at how this position would break down in a couple of different scenarios. Let's say, for example, XYZ stock stays at 100 or below throughout the entire lifespan of those options. In that scenario, both those options, the 105 and the 100 call, are going to be worthless. So they're going to lose the full $2 that you invested. But then again, it's better than having lost $3, which you would have invested if you just bought the 105 call. Now, let's say they have the scenario where XYZ rallies up to 105, and so it closes at 105 on expiration. Then you have this perfect scenario where the 100 call that you bought for $3 is now worth $5. And remember with that discussion we had on a previous episode about intrinsic value of options, this call allows you to buy the stock for $5 under where it's trading in the marketplace. So obviously it has a value of $5. The 105 call, because the stock is trading at 105 at expiration, is worth $0. So therefore you are achieving the maximum value of that spread, which is $5. And that's something else worthy of pointing out here. When you're talking about spreads, the maximum value of the spread is usually the differential between the strikes. That could vary sometimes if you do strange ratios or things like that, and we'll get into some of those scenarios down the road when we talk about more complex spreads. But for the most part, for most of your basic spreads, the maximum value of that spread is going to be the differential in the two strikes. So in this case, it's a $5 strike differential, so the maximum value of that spread could be $5. And so you achieved your maximum value. You spent $2. You can now sell it for $5. So you made $3 on that trade. And that stays the same. That ratio stays the same no matter where the underlying goes above 105 at expiration. Let's say the stock rallies up to 108. You're still going to achieve that $5 full maximum differential value of that spread. So let's say at 108, then that 100 call is now worth $8, and the 105 call is now worth $3. So you still have that same differential of $5 that you're making on that spread. So you can see the value of that spread. And so that immediately shows you why you would want to do this, is that, of course, it reduces your initial outlay and makes it much easier and less risky for you to do this trade. That's an immediate benefit. Of course, the other perhaps downside of this strategy is also immediately apparent from that example, which is the stock ran to 108 and you only made your position was only worth $5. So you're clipping your upside you're limiting your upside, I should say, to the maximum value of that spread. So in this case, if you bought the 100 call by itself for $3 and the stock ran to 108, that call would be worth $8. You would have made $5 on that trade. Whereas in this scenario, you spent $2 and the spread went to $5, so you made $3 instead. So you're limiting your profit potential on this spread. So there is a downside to trading spreads. Dan, anything you want to add there on that example, that long call vertical on everyone's favorite XYZ?
Yeah, I mean, for those of you who are paying close attention to what Mark was saying, what you can ascertain from that is that there's kind of like a magical sweet spot there, where sometimes spreads can be better and sometimes spreads can be worse. But when they're better, they're so much better. So, for example, all good traders trade with profit targets in mind, right? You don't just sit there and buy, put on some position and figure you'll just take it off when you're darn well ready. You put on a profit target. Well, let's say your target on XYZ stock is that it's going to go from 100 to 105. That's where you think it's going. That's where you'd like to get out. Well, look, here's the thing. When the stock just goes right up to that short strike price, right up to 105, having done the spread is so much better than having done just the call. Why? Because in either case, the spread or the call is both worth $5. But if you pay a third less to get that $5, it's just a way smarter trade. That's what trading is all about, is return on investment. So here, your investment is so much smaller, but your return is equal. So, this, for those of you who are brand new to spreads, this is the real hidden power of spreads. This is what you use them for, when you have a specific forecast in mind, a specific outlook on an underlying asset. Figure out the best way to trade it. Here's one of the things that I tell my students. When you have an opinion on something and you're looking to put on a trade, figure out 3 different ways to trade it. Maybe 3 different spreads or an outright and a couple of spreads, and pick the best one that is the most advantageous to you. Because a lot of times you'll find that putting on a spread instead of just going out there and buying a call is way smarter.
And Dan also outlined a useful shorthand that a lot of traders like to use when they're looking at spreads and trying to figure out, how does this work? Where is the point of maximum profit? And in most of these basic examples we're going to show you, and a lot of even the complex examples to come in future episodes, a good shorthand for looking at a spread and being able to easily identify where the maximum point of profit is to look at that short strike, because you want most of your spreads to go right to that short strike and then sit there. That is the point of maximum profit, maximum joy for the spread trader. And in this case, the short strike was the 105 strike. So if the stock ran up to 105 and sat there, that was the ideal scenario from a number of different perspectives. So as you're starting to plan out your spreads and looking at different spread options, keep that in mind. It's a useful shorthand to have when you're looking at spreads and thinking to yourself, gee, how does this pay off? Where is the ideal break-even point? Where is the ideal profit point? That is a useful barometer, particularly as the spreads start to get more complex and you start looking at it and rubbing your chin saying, gee, where does this thing actually start to make money? And Dan, you know what I'm talking about, some of these crazier spreads. We have to kind of really look at them for a little bit. So it's useful to have a shorthand in place like that when you're looking at spreads and trying to analyze them on the fly. Speaking of that kind of shorthand, there's another term we throw around pretty loosely here when we're talking about spreads in the options world, and that that term is legs. And what legs are essentially the individual parts of that spread. So let's look at that example we just ran through, that 100-105 vertical call spread in XYZ. You bought the 100 call, that is the first leg of that trade, and you sold the 105 call, that is the second leg of that trade. So most of your basic spreads that you're going to be undertaking as a new options trader are going to be very basic two-legged spreads. But keep that in mind as you hear people talking about legs and as you're executing spreads. And as also, you can use it as a verb. We often refer to legging into a spread. That is, where instead of working the entire spread as an order and sending that order in as a package to your broker, in that case, working that bid on that spread for $2 and sending that into your order, you would buy the call separately and then wait till that order was filled and then turn around and try to sell the upper strike, the other strike, the short leg of that spread individually as well. And the goal of that usually is to try to maximize the execution and get a better price, but it's a very risky type of trading, and that's called legging into spreads. So as you hear people discussing different types of spread trading, keep that in mind. And we also talked here, our example was a basic vertical call spread, obviously moving up and down the strike chain, but there also are other types of spreads, and a lot of people refer to them as horizontal spreads, which are essentially also known in the business usually as time spreads, but those are trades that take advantage of the term structure and trading various months against each other. So instead of trading the 100 and 105 strike, you might be trading the 100 strike in July versus the 100 strike in January or something along those lines. So there's a lot of interesting components that go into spreads. These are just some of the basics that you'll need to know as you're starting your spread trading in your options account. So Dan, any other points you'd like to add here for our basic training segment on spreads?
No, I mean, just the important thing is to understand spreads and to, like I say, always look for different alternatives, because one way of trading is better than a different way, and spreads enable you to really kind of wring that rag out and squeeze out every last drop of profit.
Yes, spreads are definitely what separate the men from the boys in the options world. And once you get a handle on them and how they work, you will immediately realize the benefits that they could bring to your trading, both from a risk management and from a P&L perspective. And down the road in future episodes, we plan to get into multi-leg spreads and more complex spreads and time spreads and other types of strategies that involve spreads, because spreads are such an integral component of successful options trading. But for now, that'll have to be a tease for now, because you have to make do with the basic components we discussed today, but look forward to more advanced and complex spread strategies in future episodes of Options Bootcamp. But for now, that's going to do it for our basic training segment, and now we're going to dive right into our roll call segment.
Roll call! You boots listen up while today's guest speakers are announced.
All right, and welcome to the roll call segment. This is the portion of the show where Dan and I welcome a guest from the world of Zecco so we can dive into some of the interesting new offerings and new developments that are going on over there in the land of Zecco and Zecco trading. And today's guest is Christopher Newman. He is the Zecco Trading Vice President of Service. Chris, welcome to the show.
Thank you. Appreciate it, Dan.
Vice President of Service. I like that. It's a very broad title. It makes me sound like I could come to the Zecco offices and you'll make sure I get a nice table, not by the kitchen.
Absolutely. We'll also serve you a free Coke with that.
Well, I know all those offices out in the Silicon Valley area have all sorts of fine dining options, and you can ride your scooter around. So I'm sure you have some interesting stuff going on in the Zecco offices.
Absolutely, we do.
All right, Chris. So one of the reasons we wanted to have you in particular on the program today is that, we focused quite a bit on the previous episodes on the different tools and functionality that someone coming to Zecco to the first time can expect. And obviously that's an important part of the brokerage experience. But I think another very important part, and a part that quite frankly I believe is undervalued by a lot of customers until they need it, is the support aspect, the service aspect. And that's something that I think a lot of people who are just looking at brokers and looking to compare commissions and things like that tend to forget about. There is a cost to that, and they have that sort of on-demand type of service. But now, since we are talking to a new options audience here on this program, I'd imagine support will come in handy for them because they're going to have a lot of questions. So let some of our listeners out there know what Zecco does to really make sure that newcomer to Zecco really has a good support experience from start to finish.
Great. Okay. Well, Dan, I appreciate it. In terms of a new investor, I think it's important that they recognize that, you've got somewhat of a three-legged stool in terms of price, product, and then service. And in terms of service, what Zecco does is that, one of the key items we want to do is we want to make sure we're staffed appropriately. A lot of organizations, and especially in the discount role, will skimp on their staffing model because there's not funds to be made through these service organizations, so they view it as a cost model. In terms of Zecco, obviously we take a lot of time to invest in our people, so we're staffed correctly to make sure that you don't wait a long time getting into us. But as well, we invest a lot in training. We run a 12-week pipeline. 4 to 5 weeks of that is exclusive classroom training. We do about 6 to 8 weeks of mixed production training where they maintain direct contact with their training and oversight. Last year, we invested roughly about 110 to 120 hours per FSR this past year in just maintenance training. And then secondary, we follow up and do phone routing. That's commonly used or referred to as an IVR, and we set up and optimize getting our customers to the appropriately skilled licensed professionals in the quickest time possible, because in the end, our primary focus is not allowing you to sit on the phones and in the prompts, but getting through to the right people in places as quickly as possible.
So if you get on the horn to Zecco, then you're not being routed to random customer service executive number 7422 over there in Mumbai, then.
That is correct. And we also, for instance, this past month, we've maintained an average speed of answer on our phones less than 15 seconds. So again, in terms of service, speed is a priority.
I'm glad you mentioned that speed, because that's going to be my next question here, and one we receive quite a bit from our users, and I'd imagine a lot of the listeners to this program will be interested in as well, which is how do they actually get that support? A lot of brokers will talk about, well, we have great service, but you have to go through a lot of hurdles to actually get to that support line or to those support officials. So what are the different ways that if I'm a newcomer to Zecco, what are some of the different ways that I could actually reach out to the support staff there?
Well, Zecco offers through the traditional channels that most people are fully aware of, which is the telephone. You can pick up the phone and dial us. We have a toll-free number capable of being reached as well. We do have quite a few non-domestic customers that dial us directly. As well, we support live chat, and we also work through email. But on the other front, Zecco, as a pioneer in the social investing channels, offers some more unique channels, and that's kind of an interesting one where Zecco has also moved into offering the Zecco Trading Center community, where investors can interact with Zecco service along with other investors to ask questions and obtain answers. As well, we're involved in positive outreach via telephone calls or emails when it's appropriate or it's invited by the investors. Many times they need help with something and they need us to reach back out to them, or we see something that we can proactively reach out to them and assist them on something. And then the last area is communication or interactions through. Zecco has a proprietary community, which is very interesting. It allows them to, our customers to interact, or our members to interact with like-minded investors. As well, we have a presence on Twitter and in Facebook where if someone reaches out and needs assistance, that we will communicate with them, and then frequently, if it's more of a direct account question, we'll channel them back in through a service channel to avoid uncloaking any of their personal data on a open media channel such as Twitter.
So
and
they
Facebook.
can even reach out to you via Twitter. That's pretty impressive. I like that.
Yes, we do have people that monitor that and keep an eye on that channel, and we frequently receive feedback through our folks that are monitoring that to outreach to customers.
Now, Dan, I don't know about you, but for me, whenever I see a brokerage firm or whenever I interact with them on a live chat, like, for example, you have a spread order hanging there, you might want some more insight into why it's not being filled. I'm still amazed in this day and age. I can just push that button in the platform and have the live chat pop up. It's just it's still, for you and I, having been back on the floor and having to work our orders through the ether and waiting for that random fill from the floor broker on Exchange X, to be able to pop up that button and talk to the person on the other side who's actually trying to execute that is still a almost magical experience for me.
It really is. I mean, such a divergence from what it was not too long ago.
Yeah,
man.
you and I sound like old fuddy-duddies on this show, but the funny thing is we're not that old. It's just things have changed so rapidly over the past few years.
Back in my day when
Before I had
trading.
this cane, it was interesting trading times. But,
Yeah, that's when we used to have to walk to the exchange barefoot in the snow, uphill both ways.
And it was amazing. Uphill both ways, and we defied physics that way. Or we just chose the wrong route, I don't know. But, Chris, before we wrap up here, you did mention something that caught my interest, and I think particularly because this program is aimed at options traders, you offer a little, I don't know if you want to call it a bonus, but you will go the extra mile for those options customers who call you up on the phone. So why don't you give our options listeners a little bit of an overview of what they can expect when they dial Zecco phone support?
Well, you bring up a great point, and what we've recognized is that the option traders have unique needs, and the other side of this is, as we talked about it earlier, which is speed. You guys, having been floor traders, recognize the need for speed, and delays in that are costly to investors. And so what we've tried to do is to make sure that you get priority access when you're trading options with Zecco Trading. And so what we've done is we've instituted an options line to route and prioritize option trade calls for the fastest response. The line is staffed with licensed professionals capable of answering your option questions and providing support for the options investor, but it can also provide platform navigation assistance. Some strategy questions can be answered through there. And then as well, we can take trades when we need to. If for some reason, if somebody has a system issue on their end or just needs some assistance, we're happy to help them place
So if you're
trade.
an options customer and you're having a hard time executing, let's say, a three-legged iron condor spread, and you can't find the right place to do that on the platform, let's say, you can just pick up the phone and dial in, and that phone support staff can walk you through how to place that.
Absolutely. Now, Zecco's platform has been designed to where it can support that type of trade activity where many of the platforms won't. But if for some reason you need to contact us and you route through our options line, you will get prioritized
Well,
service.
Chris, I think a lot of our listeners will appreciate that because obviously they're looking to start adding options to their portfolio. So to know that they get that little extra effort on their parts, I think will go a long way with them. And Chris, thanks again for coming on the show today. We really wanted to bring you on because, like I said, this is a often underutilized, or not underutilized, but an often less, let's say, what's the word I'm looking for here? That support and service are often areas that the typical new options brokerage customer tend to undervalue when they're first choosing a broker. And then we hear all the time from people who went to broker X because it was at this percentage cheaper than broker Y, and then they write back to us and they're unhappy with the service they're getting and the support because they realize that there actually is a cost to that sort of thing. So it is nice, I think, once in a while to reiterate the importance of support on a broker or at a broker for new options customers, because Otherwise, they're looking at a bunch of other things and they're intrigued by the various bells and whistles that the broker offers, which of course those are all important. But at the end of the day, if there's no one there to help you out when you're stuck on a trade, particularly for this new options audience, then that could be a very damaging thing, let's say.
Well, I want to thank you guys. I think what you're doing is great, because I think that when you see this, and especially when you look back at the history of the crashes of both '87 and even the tech bubble, you had a lot of investors that had stepped away, and so now people are coming back perhaps to the marketplace and need education and assistance like what you guys are providing. And so in terms of that, I appreciate what you guys are doing. I think it's important, though, that the investors that are stepping into options do remember to focus on all aspects of the equation, which is the product, price, and service. And each one of those has a unique meaning for what each investor needs, and so it's something where we're pleased to offer, I think, a pretty good value in terms of what we do on all three legs of the stool. And so we're excited that you guys are doing this type of thing in education. We thank you for allowing us to be a participant with you.
Well, Chris, thanks again for coming on the show. And we'll definitely have to bring you back on again down the road so we can explore some additional offerings you have on the support side over at Zecco.
Well, we thank you very much. I'm pleased to have been part of it, and thank you for having me on the show.
All right, and that's going to do it for our roll call segment. And now we're going to dive right into our mail call segment.
Mail call. Time to look at questions submitted by our listeners.
All right, and welcome to the mail call segment. This is, of course, the portion of the show where you, the listener, gets to chime in, and Dan and I will do our best to answer your options questions. And today's questions actually came into the optionsinsider.com via Twitter and via email. We'll start off with the Twitter question because it's the shorter of the two. It's a Twitter question from D. Schwartz, and I love Twitter handles. And he asks, he writes, you said buying options before earnings was bad. He's referring to our discussion of buying options on a previous show and some of the mistakes that novice options traders make when they're first buying options. D. Schwartz goes on to ask here, what about spreads, verticals, etc.? So obviously with Twitter, you're limited in how much you can ask, but he's obviously asking if buying options before earnings is bad, is it better to buy spreads like verticals and such like that? And the short answer to that is yes. As we saw in the earlier example, verticals and more nuanced types of spreads will reduce your overall outlay. So from that perspective, it is a better trade than just buying straight up options before earnings. The flip side is it's still buying long premium before earnings. And as we discussed on the recent program, that's a difficult trade to make profitable, particularly for a retail options trader. There's a lot of components that go into earnings trading, such as volatility, such as scalping your gamma, and a lot of other aspects that professionals are able to take advantage of to really wring every last dollar of profit out of a long premium position going into earnings. Whereas the retail usually doesn't have an account that's set up for that, or maybe they lack the sophistication to take advantage of those aspects. So it's a more difficult trade for the retail trader to really make a long premium trade before earnings pay off. You really are dependent on the underlying moving substantially in your favor, so much so that it offsets the volatility that comes in and everything else along those lines. And also what we've seen happen time and again is quite frequently the bulk of the move that would have paid off your options position occurs in the after hours. And as we all know, there is no options trading in the after hours. So unless you're sophisticated enough and have substantial enough count size to hedge your gamma in the after hours, which is a difficult prospect for retail as well, it's hard to capture that full movement. And sometimes there'll be a retracement the next day, and then the opportunity to make money on that options position is gone. So it's a difficult position to take going long premium into earnings. That's not to say you should never do it. There are certainly times when it is a viable strategy, but it is a difficult road to hoe for retail, and you really should be comfortable with options, have a substantial expertise in how options perform and an understanding of how they perform before going into those types of positions, because they are very difficult to execute and manage effectively. Dan, you have anything you want to add here for Mr. D. Schwartz?
Yeah, Mark. I mean, I agree with you. I certainly agree with you, but let's make sure we're looking at this in perspective. Before we can really talk about the answer, we first need to kind of talk about exactly what the problem is with buying options before earnings. The problem with buying options before earnings is that implied volatility tends to be really high, and that means those options are really darn expensive. So a solution to that problem is to be able to spread off some of that volatility risk. When I buy a call and then sell a higher strike call, I get rid of a whole bunch of that implied volatility risk. Now, to your point, Mark, you're right. You still have positive exposure to volatility, or what we call positive vega, but it's so much smaller and it's so much better of a trade than just going out there and buying a call. And really, the best way to look at this is with the ratio of the Greeks' delta and vega. Compared to buying a call, the delta of a spread, of a bull call spread, it gets smaller. Sometimes the delta of the spread can be about 35-40% of what the delta of just buying the call is, which means you give up a lot of your directional exposure. But the vega of that same spread can be about 10% or less of what it is just going out there and buying the call. So basically what you do is you improve the trade greatly by buying a bull call spread as opposed to just going out and buying a call. And, it's still not perfect, but it's a whole lot better. So if you are one of those people who likes to buy calls, or puts for that matter, going into earnings, you probably do a whole lot better using a vertical spread than just going out there and buying the outright option.
Oh, yeah. I think we both agree that verticals or any type of spread is preferable to just loading up on XYZ call and before earnings and just letting the dice fly, as it were. Yeah, definitely spreads are preferable in most scenarios to doing that. I just want to make sure that the listener is cognizant that it's still difficult. But you're right. That is a good point, that you can trade some delta for vega in those different types of ratios and scenarios, and that could be an interesting way, I think, for a lot of our listeners to try to play earnings. Certainly, I hope if you're listening to this show and you're thinking about doing that, you definitely want to go into earnings with a spread as opposed to some sort of naked long or short options position. And speaking of what I mentioned before we get into our next question, really quickly, Dan, I just came back from the Options Industry Conference in New Orleans. It's a very interesting conference. As the name implies, it's a very industry-heavy type of show for the large exchanges and brokerage firms. But I was able to do a lot of our Options Insider radio programs from that conference, where I get a chance to chat with all of the heads of the brokerage firms and the exchanges. And one of the questions I kept putting to them was along these same lines where I just mentioned in the earlier question. All too often we're seeing now so much of the move of these typical earnings, let's say Apple earnings, for example, last time, happening in the after hours. And we're getting so much feedback on the Options Insider that from the retail audience that's saying, wow, why can't I participate in that as well? So I kind of put it to the various exchange heads. Would you be open to some sort of after hours order book for names that are going into earnings, where retail customers and anyone else could maybe work limit orders to perhaps close out open interest and an attempt to perhaps lock in some of the profits and trade on some of the moves that otherwise that they are essentially prohibited from doing right now. And I got some mixed response for the most part. A lot of people are naturally hesitant to talk about extending trading hours because of all the costs involved. A lot of people thought you would need market makers, and that would become the difficult thing for them to do because the underlying is swinging all over the place. But a few of them got it, I think. A few of them understood that you don't need to go crazy down the rabbit hole with a ton of market makers and liquidity providers, but really a very limited order book, limited to a series of strikes around the at-the-money, maybe in the front month, to allow people to just close out positions they otherwise wouldn't be able to do, I think would have a lot of interest to people. And I'm sure that a lot of market makers would love to be able to interact with a order book full of resting retail orders, that would be fantastic for them. So there's a lot of, I think, potential plus sides. Obviously, there's a potential downsides to that too. People could get run over, they could work bad prices, that sort of thing. But essentially, if you construct it right, I think that might be an interesting thing. Is that something you think would be interesting for your clients as well there, Dan?
Yeah, I mean, I've gotten that question often from my customers as well, or my students rather as well. And honestly, I don't think attracting market makers would be a problem at all. I mean, when it comes to market makers, you build it, and if they can make money at it, they will come.
Yeah, I agree, particularly for retail order flow. That's what everyone likes to interact with. So that type of thing, I think, would be very enticing to them. So yeah, an interesting prospect. I just want to let our listeners know about that. I have been beating that drum substantially, so we'll see if we're able to gain any traction with that and perhaps open up the doors of after-hours trading in a limited potential, at least, for more retail options traders. And speaking of retail options traders, our next question came in via email from Stephen, I suppose that's Maxis, maybe Maxis, from Des Moines, Iowa. And he writes, I'm interested in trading options spreads. Well, you're on the right show here, Stephen. Mm-hmm. He writes, do I need a special options account to do this, or does the regular options account work for spreads as well? Thanks, and please keep doing the show. It has been very helpful for me. Well, Stephen, thank you for writing in. And yes, the short answer to your question is yes. The basic level 1 options account will account for some of the basic spreads that we outlined today. So if you want to, I believe level 1 approval is buying calls, obviously buying puts, and then also doing basic spreads. It might be level 2. Is that Dan, are you familiar with the various vagaries? I know every brokerage firm has it a little bit differently, but usually you can do at least a basic spread in level 1. And if not, then it's worth contacting your brokerage firm to say, hey, I would like to do simple verticals. Can you upgrade me to level 2? And usually if you show that level of interest, that's a pretty simple process. They'll bump you up. Because, I mean, quite frankly, they should be able to do it in level 1. It's a risk mitigating strategy, particularly for long spreads. You know, if I can't imagine a brokerage firm would not want them to sell a call against their long call. They don't want all the people coming in and just loading up on premium and blowing out. They much rather have people taking a much more nuanced risk perspective. So I can't imagine any brokerage firm saying to you, yes, I would like to trade a long vertical call spread in my level 1 options account, and them saying no. That, of course, being said, a lot of brokerage firms still have, let's say, an antiquated viewpoint on options and risk, and they may try to stymie that, not understanding that you're actually limiting your risk, not adding to it. Yeah,
and that's the important thing, Stephen, is every broker might handle it differently than another broker. So, you know, that's really one where you probably want to call your customer service desk over at your brokerage firm and just find out for sure. And like Mark says, yeah, I mean, they ought to let you trade spreads if they're letting you buy calls and buy puts.
I'm looking here, and I believe, at least for Zecco, who we work with on this show, they level 1 will allow you to also do covered calls and cash secured puts, which makes sense. So if you can do a cash secured naked short put, I'd imagine they would let you trade a vertical. But you know what? I don't know for sure. So it's worth, if you are trading with Zecco or whoever your brokerage firm is, and it's worth asking them specifically what levels they have and what you can do at each of those levels. Sometimes they stop at level 3. Some firms go up to level 5. They really get a little nuance with their approval levels. But for the most part, level 1 or in some rare occasions level 2 should allow you to trade basic verticals like we're talking about in the show today, Stephen. So thank you for that question, and thank you to all of you who wrote in. If we didn't have a chance to get to your question, there will be more shows to come. We'll have a chance to answer them then. And by all means, if you'd like to follow in the footsteps here of D. Schwartz or Stephen from Des Moines, then by all means, surf on over to Zecco.com/bootcamp, and you could check out the Zecco offerings there and what they have to offer, and perhaps post your question there. You can also get in touch with us on the Zecco Facebook page. Just go over to facebook.com/Zecco, and you'll see the cover art for our upcoming program there. Just click on that, and you can post your questions there for Dan and I. You can, of course, always email us at questions at theoptionsinsider.com. We'll get it there. You can also post in our forum at theoptionsinsider.com, or even direct message us via Twitter like D. Schwartz here did today. Our Twitter handle is @options. So you can get to us a variety of different ways if you would like to participate in the show. But that's going to do it for our mail call segment today. That's also going to do it for this episode of Options Bootcamp. We'd like to thank Christopher Newman from the Zecco support team for joining us on the show today to outline a often neglected but very critical portion of the brokerage equation, which is, of course, support. And the next time you have a spread order hanging in limbo and you want to know why it's not executed, I guarantee you that support equation will become much more valuable to you. So, Christopher, we want to thank him for joining us on the show today. And I also want to thank you, Dan, my cohort, my partner in crime, my fellow drill instructor, for joining me on the old training grounds today. And before we go, Dan, what is coming up over in the land of market taker mentoring that may interest our listeners?
Oh, boy, I'll tell you, it is busy over here, doing some planning for some events that I have later this year, some Traders Expos, the Dallas Traders Expo, the Las Vegas Traders Expo, and the Las Vegas Options and Futures, or maybe it's Options and Forex show. And doing a lot of traveling, going out there and having the opportunity to meet a lot of traders. So come and see me at one of those events. You can actually register for some of these things I'm talking about at my website, which is markettaker.com. That's 2 T's in a row. And boy, I'd sure love to meet some of our listeners at one of these shows.
Yes, if you are a listener and you're going to attend one of these Traders Expos, some of the other events, then by all means come on up to Dan or myself. And be sure to let us know you listen to Options Bootcamp, because we always like to hear feedback directly from our listeners. And if you'd like to check out previous episodes of Options Bootcamp or any of the other programs on the old Options Insider Radio Network, or any of the other topics we discuss on this show, such as options education, or perhaps some of the more advanced topics we have, such as advanced education, unusual activity, breaking news on the options market, all of that fun stuff, then by all means surf on over to www.theoptionsinsider.com. I believe if you're interested in options, we have something there for you. Of course, you can also find all the episodes of this program and every other show on the Options Insider Radio Network in iTunes, on Stitcher, in the Zune store, anywhere fine podcasts are purveyed. And last but not least, Dan and I want to thank all of you out there for downloading and streaming and subscribing to this program and propelling us up the iTunes charts. And we'll see you next time right here on Options Bootcamp.
This episode of Options Bootcamp was brought to you by Zecco, quite possibly the best value in stock and options trading. If you'd like to submit a question for the hosts, visit facebook.com/Zecco and post it on the Zecco fan page. Zecco reminds you that options involve risk and are not suitable for all investors. Please read characteristics and risks of standardized options at Zecco.com/ODD. Multiple leg option strategies involve additional risks and multiple commissions and may result in complex tax treatments. Please refer to the spread trading disclosure found in the options agreement and disclosure document at Zecco.com/disclosures. The Greeks represent the consensus of the marketplace as to how the option will react to changes in certain variables associated with the pricing of an option contract. There is no guarantee that these forecasts will be correct. Technical and other supporting data on this program can be supplied upon request by contacting editor@Zecco.com. Electronic trading has inherent risks due to system response and access times that vary due to market conditions, system performance, and other factors. Options Bootcamp is produced by the Options Insider Incorporated in association with Zecco Holdings Incorporated. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.